The Precious Metals Week in Review, May 29th, 2015. Brought to you by Precious Metals International. Volatility remained in the markets on this shortened trading week. Stocks plunged lower on Friday as economic data disappointed and the month of May came to a close. The number of Americans filing initial claims for state unemployment assistance rose again last week, climbing 7,000 claims to a new seasonally adjusted level of 282,000 claims. The previous week's data was also revised higher by 1,000 claims. Economists had projected claims would fall to 270,000 this week and were surprised by the jump. Despite the second week of increases, claims continue to remain below the key level of 300,000. According to the Thomson Reuters University of Michigan's monthly survey, U.S. consumer sentiment dropped in May, coming in with a final reading that was 5.2 points lower than the previous month. The declining confidence in the U.S. consumer, combined with a downward revision in U.S. gross domestic product estimates, might mean a weaker than expected second quarter as consumers tighten their grips on their wallets once again. In other U.S. news, the Chicago Purchasing Managers Index unexpectedly plunged to 46.2 in May, down from April's reading of 52.3. Any number below 50 indicates contraction in the region and may indicate a decline in consumer inflation, which could set the Federal Reserve's target for raising interest rates even further out into the future. In Europe, Greece continues to be in the news spotlight as it struggles to come to a deal that will satisfy its international creditors and unlock desperately needed bailout funding. Greece owes another payment to the International Monetary Fund next week, and the likelihood that it will have the funds to do so is in serious doubt. Nikos Voutsos, Greece's interior minister, told Greek television station Mega that money for the IMF won't be given. It isn't there to be given. A senior Greek official with knowledge of the government's funding position confirmed to the Financial Times that Athens would be unable to make the IMF payments, which fall due in 4 separate installments of more than 300 million euros, each between June 5th and June 19th. Despite such news, according to Reuters, which cited an anonymous spokesman, Greece intends to reach an agreement with its lenders on a deal by Sunday. Christine Lagarde, head of the IMF, said, "A Greek exit is a possibility." In an interview with German newspaper Frankfurter Allgemeine Zeitung, which was due to be published on Friday. Ms. Lagarde went on to give further detail, saying that a Greek exit from the EU would not be a walk in the park, but would probably not mean the end of the Euro project. Bill Gross, speaking on CNBC on Wednesday, said that a Greek exit from the Eurozone could discombobulate currencies and open the door for contagion to other heavily indebted nations. In his interview, Mr. Gross, former head of bond giant PIMCO, said that an exit from the EU by Greece would lead to speculation regarding Portugal, Spain, and likely Italy as well. In the United Kingdom, the Bank of England has apparently been researching the financial impact of an affirmative vote on a planned 2017 referendum on whether the UK itself should remain a part of the European Union. In what was supposed to have been a confidential email message that was missent to the Guardian newspaper, details of a study called Project Bookend were revealed. The Bank of England was forced to admit that the Guardian story on the incident was true, saying it should not come as a surprise that the bank is undertaking such work about its stated government policy. There are a range of economic and financial issues that arise in the context of the renegotiation and national referendum. It is one of the bank's responsibilities to assess those that relate to its objectives. Economic data out of Japan was conflicting this week. Industrial production and inflation beat expectations, but consumer spending still seems to be stagnant, despite upbeat jobs data, which many analysts thought would trigger consumer spending. A report from DBS after the data was released said, plainly, a consumption-led economic recovery is not yet in sight. The report went on to note that it is critical for Japanese consumption to speed up if manufacturing and exports begin to slow along with the global economy. Crude oil saw modest support this week as U.S. crude supplies fell for the fourth week in a row. Traders appear to have taken the supply reduction as a sign that global supply may be regaining normal levels after a long period of oversupply. Offsetting the supply reductions, however, weekly crude production in the U.S. hit its highest level in 44 years this week, despite the 25th straight decline in the weekly oil rig count for the U.S. This may be signifying that oversupply could continue to be a problem on a global basis. The euro dropped against the dollar for much of the week, finding a bottom late on Wednesday, following a sharp drop. Following the brief plunge, the euro began recovering against the dollar and appears set to close the week only slightly lower. The Japanese yen also spent the week dropping against the dollar. The yen found a bottom late on Thursday, but the rise from there was only slight and appears to have been short-lived. The yen will close the week lower against the US dollar. Volatility should be expected to continue. The weekend news may prove pivotal to markets next week, as the deadline for Greece to reach a deal with its creditors looms near. A failure to come to agreement this weekend will likely mean that Athens will be forced to default on its debt repayment to the International Monetary Fund on June 5th. As usual, the mainstream media is downplaying the fact that Greece may not meet its June 5th payment, pointing out that technically, Greece has until the end of June to make all of its payments to the IMF. A default by Greece on its bailout program could set a precedent and open the door for other struggling countries in the Eurozone, such as Spain and Portugal, to back out of their own bailout-forced austerity measures. In the UK, whether or not they remain part of the Eurozone will apparently come down to a vote in 2017. An event which the Bank of England is quietly preparing for with its Project Bookend study. In a terse and completely underreported Reuters article out of Vienna, Austria, on Thursday, Reuters reporter Michael Shields essentially brushed aside what we deem to be an important move by the Austrian Central Bank. We shall quote Mr. Shields' entire article for you, as edited by Jason Neely, also of Reuters. A decision by the Austrian Central Bank to repatriate some gold from London by 2020 is absolutely not related to the possibility that Britain will leave the European Union, Governor Ewald Watney told a news conference on Thursday. He said it instead reflected a trend among central banks, including Germany's Bundesbank, to hold more reserves at home. The entire article, including reporting and editing credits, took up 6 whole lines on Reuters' website. Excellent reporting, Mr. Shields. The public surely appreciates your obvious doggedness in digging deeper into the fact that yet another central bank desires to have its gold back under its own roof. By Friday, CNBC had noticed the Reuters story, and oddly for mainstream media outlets, chose to provide more detail. According to CNBC, Austria apparently intends to reshuffle the percentage of its gold held abroad by the year 2020. Currently, the Austrian Central Bank maintains 17% of its gold holdings at home, 3% in Switzerland, and 80% in the UK. By 2020, Austria intends to hold 50% of its gold at home, 20% in Switzerland, with the remaining 30% in London. The bank said, upon the release of its annual report on Thursday, starting from mid-2015, the new storage policy will be gradually implemented in keeping with security and logistical requirements. A comprehensive review and, if need be, adaptation of the storage policy is scheduled for 2019. The move follows similar ones by other central banks around the globe, such as the Dutch Central Bank, the aforementioned Bundesbank in Germany, and a push in other countries such as Switzerland for more national gold holdings to be held on native soil. It will be important over the weekend to keep an eye on Europe for an update on Greece. If an agreement cannot be reached by Sunday, as the Greek government expects, then next week could see a scramble by the Greek people to try to pull cash from their already struggling banking system, which may result in capital controls. If capital controls go into effect in Greece, then other struggling and debt-laden countries in the Eurozone could see their own runs on their banking systems, as local citizens ask themselves, can such a thing happen here? Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, May 29, 2015. Brought to you by Precious Metals International.